Welcome to the Tech and Transitional Energy podcast at VSA. It's Thursday the 31st, and it's myself, David Scriven, and it is Phil Smith who joins me on a rather chilly day. How are you? Did you put all those warm clothes up in the attic and now had to put them all down again?
We've had snow up in Newmarket, David, and the sun is now shining brightly. So one minute very, very cold, and now it's getting a lot warmer. So let's hope it stays that way, but I fear it might not. So very mixed weather and very much like the markets at the moment, I feel.
Absolutely unpredictable. Anyway, I just wanted to sort of highlight our great leader is not with us at the moment. And I've been sort of scouring the world to try and find out where he is. And he wasn't at the Oscars. Now, talking of the Oscars, Netflix had a setback. And Apple became the first screening service to win an Oscar for the Best Picture Coda. So think of that in line of, though, all people who are FANG watchers, because Netflix has underperformed. Now, having said that, of course, the NASDAQ has recovered quite dramatically since mid-March. And that's a very interesting feature of the markets at the moment, bearing in mind what's happening in geopolitical events, etc. And not least for the fact that US government bonds are about to complete their worst quarter for total returns in the past 157 years. Anyway, notwithstanding that, it is also interesting to see that from the 15th of March, the Fed, when it outlined its interest rate path, has given some comfort to equity markets. So that in mind, and the fact that the FTSE has recovered a bit, but of course it's tech light, so it's been the oil and gas sector and the metals that have been supportive, but we'll come into oil and gas a little bit later on in relation to one of the companies that we're going to talk about. But anyway, I think we should perhaps get started and first of all talk about SDCL Energy Efficient Income Trust, SEIT. We don't have a ranking on it, but SDCL Energy Efficient Income Trust is the first listed company of its kind to invest exclusively in the energy efficiency sector. So, Phil, could you kindly elaborate a little bit more about them?
I will, David. I just thought this was quite appropriate to mention, given what is happening with the global energy mix, energy prices, and the impact on us all. And this income trust listed on the FTSE 250 in 2021. And according to the company, the projects that it invests in either provide decentralized on-site generation of power and heat, or projects that actually reduce energy demand. So quite an interesting area this is involved in. And the company's assets are across the UK, Europe, and North America. So geographically, quite well spread. And they announced this week that they were raising £100 million by issuing 87 million shares at an issue price of 115p. So they also said that investor demand exceeded the maximum size of the placing and had to scale back. So clearly quite a lot of interest in this, and I think one that we'll be looking at more closely. So that's SDCL. The ticker on that is SEIT. And on the subject of sort of energy and energy efficiency and procurement, David, I think that you'd noticed results from Inspired PLC this week.
Yeah, so I took note of that. Actually, it's a slight eye catcher, not least for the fact that the share price, which had pulled back a little bit, along with many others, are now close to its all-time high. So Inspired PLC in July 2021, the Inspired Energy PLC became Inspired PLC. The name change was affected to reflect the structure into which the group has evolved, a technology-enabled service provider with the market-leading position for energy procurement, utility cost optimization, and sustainability enhancement in the UK and Ireland, with 3 clearly defined divisions: Inspired Energy Solutions, Inspired ESG, and Inspired Software. Now, their results were revenues up 47%. They've turned profitable. Gross profit was up 30%. And they've been acquiring businesses which they can cross-sell to their model of net zero carbon services. So I think the company was called BusinessWise that they concluded in those results. And it looked really like a company worth keeping an eye on, and impressive that the share price, may be moving towards making a new high.
Yeah.
Now, so, that's not one we follow at the moment, but as I say, keep an eye on. Now, one we do follow is Pressure Technologies, and they had a trading update for the first half of 22, and it looks really encouraging. We're very excited by these, and Phil, if you could kindly go through that, but thematically they're on the mark, and it looks very interesting.
Yeah, well, this is I'll better point out first, this is a corporate client of ours. Pressure Technologies, the ticket is PRES. It's 25 million market cap, so it's a smaller company, but one, as we will show, is growing. This company is a very long-established British engineering company, and they're based up in Sheffield. They are highly specialized engineers, and they have two divisions in the business. One of them is Chesterfield Special Cylinders, or CSC as they call it, and the other is Precision Machine Components, or PMC. Now, CSE is one of the country's oldest makers of cylinders. Now, these are very special cylinders. One, they contain gases at extremely high pressures. Two, they can make these, and they are very, very large. Because they're extremely high pressures means that safety is absolutely critical, and the engineering standards used to make these are very high indeed. Such is the quality of this product that it's used in our nuclear submarine fleet. So they reported trading update for their first half. Their year ends October 4th. And they said that for CSE, for the cylinder business, their order books have reached the highest level for 5 years, with order intake, particularly on defence contracts, increasing during the first half, with manufacturing expected to commence in second half. Now, a very exciting part of this story is these are cylinders to contain high pressure gas, and the group is actually working with Shell on developing cylinders for hydrogen refueling stations for vehicles. And they said today that visibility of future demand from existing and new customers is steadily increasing. And obviously hydrogen is seen as a key element for achieving net zero in transport, and that the pipeline of opportunities for static and mobile delivery systems as in hydrogen grew significantly, which is super news. They've not only got Shell as a client, but McPhy Energy and Haskell Hydrogen Systems, which are, they're part of Ingersoll Rand. So that is all very good, and that's for the CSC business. The PMC business, so it's a machining business, they machine parts for the oil and gas industry, particularly subsea structures and valve assemblies. And this has obviously clearly struggled because of the downturn in oil and gas spend when the oil price fell a couple of years ago, but the oil price has been clearly recovering. And they have customers such as Schlumberger, Halliburton and Baker Hughes, and so they're seeing a recovery in demand from them. They said that they're in line with market expectations for trading, and we're forecasting, given the recovery in oil and gas, the growth in the hydrogen business, the defence business, the EBITDA to rise from $500,000 in 2021 to $3 million in 2022. So an excellent trading update from them.
Indeed it was. And could you also comment, because I guess input costs are going up, so how can they manage that? I mean, is steel, for example?
Yes, they are. Yeah, the steel price is yes, that is going up. Obviously, you've always got challenges on supply, so they work very closely. They have two main steel suppliers who they agree pricing with. So no, they're working very closely with them to control their pricing. They outlined how well that work is going in the trading update today.
Yeah, and also noticed, I think, that they're expanding their capacity at Sheffield, so all rather encouraging.
Yep, yep, yeah, it is. Well, they've got a great, super British engineer.
Good stuff, sir. Okay, so I think moving on, the other company that we'd perhaps like to touch on is ZAR, Z-A-R, which had full year results to 2021 ending 25 million with closing cash. So if you could kindly comment on that.
Yep, so ZAR, this is a Cambridge, originally Cambridgeshire-based printing technology, and they make, so ZAR is a XAAR is the spelling that the ticket is XAR. It's 192 million market cap. So this company, what it does, it develops digital inkjet technology, and in particular produces piezoelectric drop-on-demand industrial inkjet printheads. What is an industrial inkjet printhead? Well, this is not office printers. These are printers that are used on production lines. So you think of, things like if you buy, food products, all the printed packaging units of food products. You've got things like drugs, but also you have things like printed tiles and ceramics, for instance. And these are, so there's a whole range of applications where industrial printers are used for promotional material, but particularly for ZAR, things like medical equipment, automotive parts, particularly labeling automotive parts, tool parts, appliances, all sorts of end applications. And ZAR has been in a turnaround period. I think they went through a period where they were a major supplier into the China tile markets, and those markets, struggled, and they've had to, ZAR have had to move into newer markets, but they're in the second phase of a 2-year turnaround. The first phase, clearly, when there's major disruption, had to stabilize the business and reset the strategy, which they've done. And they've managed to simplify the technology offering. They've focused the routes to market. They've removed third-party distributors. It's more now direct sales into OEMs. So you've got close relationships. So this is starting to bear fruit. And we saw some of that in their results. So the full year results, sales were up 23%. Gross margins have improved from 27% to 34%, which is super. Shows that customers are willing to pay for the product and pay a good price for it. And adjusted EBITDA from break even up to a 3.2 million EBITDA. So I thought, turnarounds are always very difficult to execute, and this seems to be going very well indeed. And in fact, they've said that 2021 revenues from ceramics, like tiles and the glass sector, was up 40% over 2020. So, well done to them. And good recovery plan being put in place there.
Yeah, no, that's great. I mean, that's another one almost in the stable that we've had today of sort of, particularly two of them, the models now bearing fruit and turnaround happening for them. So very encouraging trends indeed. So another company that you flagged that you would like to have a chat about is Kooth, K-O-O, 79 million market cap, I believe. Sorry.
Yeah, it is. Yeah, indeed. Sorry, David, interrupted you there. No, they've had results. Let me just talk about why I think this one's quite interesting. So they're a UK-based company, and they provide a software platform for digital mental health care. Now, their platform provides online counselling support to children, young people, and adults in need. Mental health care in the UK is a significant mental health issue, significant and growing issue. So it's a structural, very sadly, a structural growth driven story here. And they said in their results that there are over 7 million children and young people who got access to the Kooth platform across the UK today. And 1 in 33. So they've actually got access, but 1 in 3 access to the platform. 1 in 33 access to the platform in 2021. But what's really interesting here is they're seeing growing demand in the public sector for adult access. In 2021, they added 14 new contracts. with providers, and they have 3.8 million adults on the platform. And so they go into a lot of detail about the numbers of people that have access to the platform. But what I found quite interesting here is the relationship with the growing relationship with the NHS in the UK. And and they point out that the NHS spends £11 billion a year on adult mental health. And as we know, and it's very well publicised, there's a huge demand and backlog for this. So this is almost like an intervening step to full NHS care, but it helps provide support. Anyway, so that all said, they reported their revenue was up 28% to just under £17 million, and that their adjusted EBITDA, so profits, have grown from 0.9 million to 2.1 million, and their margins were improving. So, I an interesting story with a lot of potential structural growth. And if you look at the ratings, it is highly rated as a stock. It's on EV net revenue multiple of 3.6 times, EV EBITDA 34 times, but then the EBITDA is expected to, this is from Icon forecast, by the way, expect to double in 2022. And they've said that 90% of the current revenues are from recurring annual contracts, which is very good as well. And the company has cash. It's the net cash at the end of the year was £7.1 million. So that it's you've got to do your research and all that, but it looks like a very interesting structural story given the demands on the NHS and within the UK society for mental health support.
Yeah, no, really good to hear about someone providing a great platform for this particular need. And I'm imagining that COVID hasn't helped as well for particular people who might be suffering from the condition. So really pleased to hear about that, and great they've got the cash too. So
yeah,
that's a good backdrop as well. So no, thanks for that. And then it brings us to Equals Group. And I might just quickly mention that I got so carried away on Inspired that I mentioned that their share price was a little bit higher than what it was. And I had the Equals Group in mind. So I do apologise. That was my fault. Equals Group is close to its all-time high, whereas Inspired has got a little bit more to catch up. But their revenues and everything, as I mentioned, were very good. So Equals Group, so this is a payments company, and they're another one that falls into the theme of changing the model and focusing in a good way that's turned very positively for them. So if you could kindly lead us through that one.
Yeah, I can't. This first time they had results today, full year results. So it's Equals Group, as in the mathematical equals. Ticket is EQLS. It's 135 million market cap. And it's a fintech payments company, and they say in a description they provide small and medium-sized enterprises a suite of payments products across foreign exchange transactions, prepaid car solutions, faster payments, and accounts into which receipts can be credited and payments made. Well, if you run a business and you're buying and selling overseas, importing and whatever, you'll know all about this, I'm sure, and a lot more than I do. Anyway, the company says that they describe themselves as being fairly unique in that their product spans account-to-account transfers and cards and quote overlaid infrastructure providing bank-grade connectivity and security. Clearly a very good thing as far as payments are concerned. And what was also caught my eye with this is that they said that their business customer revenue, remember there's Forex in here, increased to represent 81% of total revenues. This was up from 70% in the UK. So this is not like relying on, travel Forex. This is very much business to business foreign exchange. So there'll be an element, I'm sure, of stickiness in their revenues. So in terms of the actual transactions that went on over their platform, they said that they increased by 63% to £5.7 billion during the period versus 3.5 billion previously, which is very good. And this dropped through to their gross profits were up 30%. to £24 million, and their adjusted EBITDA up from 1.1 million to 6.7 million, and year-end cash was up 30% to 13 million. So all moving in the right direction. And just looking at the stock ratings on this one, their EV/NR net revenue multiple is 3 times, fallen to 2.5 times, on revenue growing from 44 million this year just gone to 54 million 2022. This is Icon forecast from Refinitiv. Consensus forecast, and EV/EBITDA ratios forecast fall from 40.2 to 9.9 on EBITDA, growing from 6.7 to 9 million in December 2022. So to my mind, I mean, that looks quite, obviously investors need to do their own research. It's not a recommendation, but those look reasonable ratings on the company, and certainly this one looks to be, worth a further look by investors.
Absolutely, and take that comfort on the cash position, because it's so important. I think in tough times, you can't beat it, having an encouraging position like that. So I think that probably wraps us up today. Thank you very much to the listeners. Thank you very much, Phil, for your very insightful comments. And we'll call it a day and look forward to the next time we come onto the podcast. I think our dear leader will be back in the driving seat.
Oh, well, we look forward to seeing Andrew back. However, I have to say, David, I've very much enjoyed sharing the podcast with you.
It's been a pleasure. Many thanks.
Thank you, David.